Hi everybody, it's Peter Schiff. This is Saturday, August 6th, 2011. Last night, S&P downgraded U.S. sovereign debt from a AAA to a AA plus with a negative watch. Now, I don't know if August 5th will live in infamy the way December 7th, 1941 does, but it's a very significant date nonetheless, because it really marks the first time that a credible, and I put that in quotes, rating agency has acknowledged that maybe the emperor is in fact naked. Now, I mentioned on my video blog that I recorded last Saturday that I did believe that Congress was going to compromise and raise the debt ceiling, but in a way that didn't make any real cuts in government spending. And that's exactly what happened. That left S&P in a credibility box, because it had said if there were no credible cuts, they would downgrade. Now, Moody's or Fitch made such statements, so they were able to chicken out the day of the deal on Monday and reaffirm their AAA rating on the U.S. government. But S&P was in a box, and fortunately, they did the right thing and downgraded them. I think the only thing they did wrong is they didn't downgrade them far enough. They did leave it at a AA plus with a negative watch, and they did mention that they might bring it down to AA in the next couple of years if the fiscal situation deteriorates, which it surely will. But I don't think the U.S. deserves to be AA plus. After all, New Zealand is AA plus. The New Zealand dollar is making record highs. Net public debt in New Zealand is about 10% of GDP. They're far more solvent than the United States. I would much rather buy New Zealand government bonds than U.S. treasuries. So they're going to have to fix that. Maybe they'll upgrade New Zealand back to AAA at some point, or eventually downgrade the U.S. Now, it's interesting that you're getting a lot of criticism of S&P by the administration, by Congress, by people in the media. And part of the criticism is, well, why should we care what S&P says? After all, they missed subprime. They got that wrong. Well, so did Moody's. So did Fitch. So if you're going to say, why should we believe S&P, then why should we believe Moody's or Fitch? Why should we think their AAA is any better than the AAAs that they gave on bonds backed by subprime mortgages, which went to zero? The fact is, if you're going to question their credibility, and I believe you should, it's based on the fact that their ratings are too high, that they often base their ratings on political considerations or conflicts of interest that don't render their opinion truly objective. So if you're gonna question S&P, and of course you got to question Fitch and Moody's, it's not because they're rating the U.S. government too low, but because they're rating it too high, because that was the mistake they made with subprime. They put too high a rating on a security, not too low. And of course, the fiscal situation is going to deteriorate because we are either in or on the cusp of a brand new recession. And remember, contrary to previous recessions, this one is starting with unemployment above 9%, starting with interest rates already at zero. So imagine what's going to happen when we get the next round of fiscal stimulus. They're going to blow the deficit off the charts. And of course, the Fed can't do anything on the rate front. All they can do is print more money, which destroys the value of U.S. bonds. So I think S&P, again, is being much too generous with their rating forecast. And, you know, if you want to talk about credibility on ratings, I've got some credibility. I didn't miss subprime. You know, if you didn't watch the video of my presentation in front of the Western Regional Mortgage Bankers Association, you know, look for it on YouTube, Peter Schiff Mortgage Bankers. Back in 2006, I told those mortgage bankers that S&P was putting AAA ratings on bonds that were practically worthless, that I thought should be junk. So I didn't get that wrong. I did say that those bonds would go to zero, and that's exactly what they did. And of course, the president, Congress, all the people who were criticizing the rating agencies for getting it wrong, well, they got it wrong. They missed subprime too. So if they want to base credibility on whether or not you got subprime right, why don't they pay a little attention to what I've got to say? Why don't they listen to this video blog to have a better idea of what's actually going to happen? Now, what's going to happen on Monday next week? Here's what I think is going on. First of all, in the last week, the major stock markets around the world plunged. I mean, it was about a 10% plunge across the board. Europe, Asia, Latin America, the U.S., the markets got clobbered. at a pace we haven't seen maybe since the financial crisis of 2008. And if you contrast what happened to today or in this week with what happened to the dollar soared in 2008 on this perceived flight to quality. The dollar did not soar this time. In fact, it barely budged. I mean, it went up a little bit against the Aussie and the New Zealand dollar, but that's because those currencies were at record highs. So obviously there was some profit taking. You know, with all the problems in Europe, all the focus on Italy, on Spain, on Portugal, the euro barely budged. I mean, it went down against the Swiss franc. The Swiss franc made a record high against the euro and the dollar, but the dollar didn't go up. What made new highs? Gold made a new record high. And in fact, the media likes to talk about the fact that gold sold off on Thursday along with everything else. It barely sold off. It was down 0.5%, and it recouped all those losses today. It would be at a record high or rather yesterday, Friday. It would be at a record high right now if it hadn't made an intraday record high the day before on Thursday. In fact, I think it closed at a weekly closing all-time high. So the dollar is not the go-to currency the way it was. It is not the safe haven that it was. And in fact, also on Friday, the ECB came out and said that it would buy Italian sovereign debt, provided that Italy balanced its budget. And yesterday, Italy came out with some real serious proposals for significant cuts in government spending, real cuts, not the phony cuts that we got here in America. So I think what you're going to see happening in the weeks ahead is the market is going to get behind the euro and dump the dollar. You know, everybody has been focused on the euro, the eurozone, and at the same time, they have neglected to look at the real problems for the dollar. Because while Europe might be getting its fiscal house in order somewhat, I don't think what Europe is going to do is perfect, but it's much better than what the U.S. is doing. And so people have been focused on that sideshow in Europe. They have ignored what really should be the main event here. And the fact that the dollar had such a pathetic rally when the stock markets were coming unglued, when all the focus was on the problems of Europe, that shows you where the dollar really stands. And, you know, the Swiss franc and the yen made record highs on the week, but there was intervention. The Swiss National Bank intervened. The Bank of Japan this week had its biggest intervention in history. I read that they might have spent the equivalent of $50 billion to stop the dollar from collapsing against the yen. So the dollar was on life support. Contrary to 2008, where the dollar was rising, foreign central banks had to prop it up. Now, treasuries were still rising. We've been in a bull market for a long time. But I expect, even though this downgrade was anticipated, I think a lot of people didn't expect it happening so quickly. And given what's happening over the weekend in Europe on a positive front, I think this news could be taken very poorly, if not in the days ahead, in the weeks ahead. And the U.S. Treasury market is going to come down. And as it comes down, that is going to increase the cost of financing for the U.S. budget deficit, which is going to expand based on the weakening economy. In fact, as we move back into recession, the government is going to collect less revenues than they anticipate. They're going to spend more money than they anticipate, including more money on interest payments on the debt. So in other words, we get a self-perpetuating loop because as the fiscal situation deteriorates, S&P now has to come out and downgrade the U.S. government again. And of course, Fitch, and Moody's, they can't sit back and do nothing while S&P is downgrading again. So they're going to downgrade. And then what's that going to do? That's going to drive up funding costs even higher, worsen the fiscal situation even more. And then you get a self-perpetuating loop of downgrades followed by a deteriorating environment, higher interest rates, a weaker economy, more downgrades, ultimately forcing real austerity on the United States or runaway inflation as the Federal Reserve prints money to buy all the bonds that nobody else wants. And that is what S&P is really rating. When you're rating sovereign credit, where the country is borrowing in its own currency, it's not necessarily default that you're concerned about. It's that they print money to avoid default because our leaders lack the political will to do what's right. And the one thing that we proved with this budget farce was that we don't have any leadership or any political will in Washington to do the right thing. Everybody chickened out. The Republicans, the Democrats, and the people who are saying that somehow the Tea Party held everybody hostage and the Tea Party got a victory. The Tea Party was shut out. The Tea Party wanted real cuts in government spending. And my hat's off to the people who voted against this budget compromise. The interesting thing is the budget compromise had more support in House Democrats, in House Republicans than it did in House Democrats. So if you think the Tea Party changed the Republican Party, think again. They sold out those Tea Party principles. In fact, any of the Republicans who voted to increase the national debt should be voted out of office. Because as I said many times, the problem wasn't the debt ceiling. The problem was the debt. The ceiling was all that stood between us and a financial crisis. By removing the ceiling or raising the ceiling, we allowed our leaders to pile on even more debt, to grow the government even bigger, and bring us one step closer to fiscal Armageddon. And S&P finally acknowledged that today. And, as I said, other people like myself have been saying it for years. But this is the first time a highly credible, and though maybe not credible to me, but credible to the financial community, has come out and said what every other organization has refused to say, that the United States does not deserve to be AAA rated, that we are not risk-free, and that the U.S. Treasury is no longer the risk-free rate. And yes, that's going to affect the rate that everybody pays on dollar-denominated debt, because if the U.S. Treasury is in AAA, then none of the states can be AAA. Then no U.S. corporations can be AAA, because the U.S. government can always tax them to pay its bills. The reason that no corporations could be AAA anymore is because if you're worried about the value of the dollar, all those bonds are dollar denominated. And if the U.S. dollar is a junk currency, then anybody issuing debt in U.S. dollars is issuing junk paper. And so what S&P needs to do now is look over all the corporate debt that it still has rated AAA and downgrade it. Because it makes no sense to have the U.S. government AA+ and somebody else having a higher credit rating in the United States than the U.S. government, because they are issuing the exact same currency. So that is my warning to everybody, and I've been saying it. You can't just get out of treasuries. You need to get out of all debt denominated in U.S. dollars, because that's really what S&P is saying here. S&P is saying we have so much debt that if you buy treasuries, you're going to lose, because you're going to be paid back with inflated dollars. Well, if you lose on treasuries, you lose on any bond that's denominated in dollars. In fact, you lose on your dollars if you have them in the bank, if you have them stuffed underneath your mattress. S&P is telling you, get out of dollars. That's what I've been saying, and now they're saying it too. Even if they won't tell it to you that straight, they want to sugarcoat it. I never do that. Anyway, on that note, enjoy the rest of your weekend. Again, I apologize for my voice. I've been having a tough time. Remember, we're going to be talking about this a lot on my radio show, Schiff, the Peter Schiff Show at schiffradio.com Monday morning. So don't forget to tune in. Anyway, take care, everybody. Bye-bye for now.